Hello everyone, happy Friday. It's your girl, #JLoan in the building. And today on the JLoan show, we have a very, very special guest. And the reason I brought Ron on here today is the number one question that I get in our business is about credit. And how do I increase my scores, or how do I get scores, or maybe my credit's ruined for various reasons, whether it was just mismanagement, death, divorce. There are many reasons why someone's credit ends up in a position where we may not be proud of that, and you still want to buy a home, or maybe you don't even want to buy a home. Maybe you just want a better quality of life, right? Because having great credit is like having great friends. I don't know.
Well, it is. And, credit impacts pretty much everything we do in the financial world today. And what I've found is that a lot of people don't understand just how much of an impact it can have, as an example, on your auto insurance or your homeowner's insurance or the rate that you pay for an auto loan.
Okay.
There was a study done by the Insurance Journal on homeowners insurance, and they found that people with poor credit scores compared to those people with excellent credit scores pay as much as 3 times as much for their homeowners insurance. And kind of the same thing with auto insurance. Consumer Reports did a study, and the results for Texas showed that on average, people with poor credit scores paid 2.5 times as much as people with great credit scores.
Wow.
So you start looking at that, and all of a sudden those dollars add up in a hurry.
Right. So it's safe to say that not even on the mortgage side, that if you own a car, or it can even be, I'm sure credit card interest may reflect on that. So it could affect someone's ability to even save for a home, because they're paying so much more money just because of their credit scores, right? So you guys hear that. Although we knew this, it's sometimes easier to hear it coming from the horse's mouth themselves. So everyone knows I try to do as much as advising as I can from my expertise over the years. But I wanted to bring Ron in here today. He's from Ace Credit Consulting. His information is on the board, so that when we're done, if there's questions that are not answered on here, you can reach out to him directly and see if we can get you on your way to better credit scores, hopefully home ownership in 2020 or 2021, however long it takes to fix, because everyone's story is different.
Absolutely.
And all credit can't be repaired in 2 months or 6 months. Everybody's story is a bit different, and it takes time.
That's right.
So could you talk about, one, what you do, and give the viewers some advice? Tell us. I mean, when I met you at a luncheon, and you did a phenomenal job of talking about credit and how you can help and how it hurts and things of that sort. So I'm going to give you the floor to you.
Okay.
I'll be quiet until I have a question, or maybe a viewer has a question.
Sure.
And then we'll kind of go from there.
Sure. Well, our core business is helping people take a look at why their credit scores are where they are. So the first step in that process, obviously, is to look at the credit report, to see what's on there, who put it there, how they reported it, and it gets into a lot of detail that can be very, very difficult and challenging for the consumer. And I'll just give a blanket example. So let's say somebody went through a tough time, extended job loss, divorce, what have you, and they had a credit card that they had to let go. So now they've got this $5,000 collection on their credit report. Well, it isn't so much that it isn't their account, but if it got reported inaccurately, which happens a lot, it can make that credit score look a lot worse than it actually should be. So what we do is we analyze these credit reports, find this information if it is there, and then in the case of somebody applying for a mortgage, you as the loan officers know what credit score you need to get the loan approved. So we compare that to where they're at, and then we can make a determination as to whether we can help get them from where they're at to the score you need in a relatively short period of time. And if so, then we can get into the detail with the client as to how we do that.
Now, are there ever times with, I hate to say it this way, but are there some clients that you pull and say, oh gosh, we can't help you? Is
Absolutely.
there ever that situation?
Oh, absolutely.
And what,
happens a lot.
Why? What determines whether you can or you can't help them? Give me an example of something you'd be like, there's nothing that we could do.
Well, let's say somebody has had late payments or charge-offs or collections, any negative or derogatory information that's showing up on the credit report. If that information is accurate, then it is what it is. And the only thing that really is going to help that is time.
Time away from delinquency.
Well, yeah, I mean, it's just, once it's done, generally speaking, by law, negative or derogatory information can stay on a credit report for 7 years.
Okay.
So as time goes by, the older it is, the less impact it has on the credit score. So if you've got a brand new collection from a few months ago, that's going to hammer your credit score pretty good.
Right.
And there's a lot of credit repair companies out there that say, oh, well, no problem, we can just wave our little magic wand and make that go away. And if somebody says that, my first advice is put one hand on your wallet before you do anything else. Right. Because let's face it, talk is cheap.
Right.
And the proof is in the pudding. So, but all that said, I think that the big thing is the old adage, an ounce of prevention is worth a pound of cure. Said another way, if you understand how to get and keep a good credit score, it's a lot less time, energy, and money to do that than it is try to recover from getting a poor credit score. Okay.
So would you say you advise more on, what would be your best advice to someone who is looking to establish credit? What should they do? What should be the first steps that they should do to help them get a score?
Well, the credit reporting agencies would like to see, as a minimum, one installment account, such as a mortgage or a car loan, and two, what they call revolving accounts, which typically are credit cards. Okay. Now, if somebody doesn't have credit, it can be very difficult to get credit. So I think your question is, if somebody can't get approved, now what do we do?
That's correct.
Well, there are several options. Number one is something called authorized user. So if the person that doesn't have credit can go to a family member, perhaps a parent or a spouse or a sibling, and that person has got an account, a credit card, let's say, that they've had for 15 years, they got a high limit, relatively low balance, they can put that person on that account as what's called an authorized user. And when that happens, all of that wonderful 15-year positive credit history shows up on the new person's credit report, which definitely can help their credit score. So that's number one.
And can I stop you for 1 second?
Absolutely.
there? The key to that is that you want to make sure that you choose someone that you trust, because when you become an authorized user, if they're on there and they default, it also goes on your credit. So a couple things you want to make sure: one, someone who has long established credit, because the longer the better for you. But two, that they maintain their balances very well, because you don't want someone who has a $5,000 card with a $4,900 balance either, because the balances to limits ratio hurts you as well, correct?
Absolutely.
Okay, so
Absolutely. Choose
someone you trust, and I always tell the person who's the authorized user that's giving you the authorization that they don't even have to give you a card. So it's really just to help you build your credit, because a lot of the times people get nervous. Oh, I don't want you to have access to my card.
Right.
You're actually helping them in their future, but you don't even have to give them don't even order another card for the person that you're on there. You're just helping them establish credit, and then obviously once they've established their own, you can remove them as an authorized user once they've been able to establish their own.
That's right.
Correct?
Yes, and that was going to be my next piece of advice, was Authorized user is great, but you really want to start building your own credit in your own name. So again, if you can't get approved, there's a couple of different options. Number one is something called a secured credit card. And how that works is you go to the credit card company and you put up, let's say, $500. And
of your own money.
Of your own money,
Okay.
and then they give you a credit card with a $500 limit.
Okay.
Works like any other credit card. Keep your balance low, and typically after about 60 to 90 days, you start getting the benefit of that new positive account.
Okay.
So that's number one. Secondly, we as a company came across a credit card about 3 years ago that is kind of unique in the sense that it's only good at one company, which happens to be a jewelry company of all things.
Okay.
But the great thing about it is that it's got a $5,000 limit.
Wow.
It is a guaranteed issue regardless of credit score.
Okay, so guaranteed issue means that doesn't matter what your score is, you'll get this card to help you establish
That's exactly
credit.
right.
But
And
we don't want them to use that card and then get blinged out, right? We don't want them to be walking around with all the jewelry on, right?
preferably not. Preferably not. And in order to get the card, I mean, let's face it, nothing's free, right?
That's correct.
So for this particular card, and it does report to all 3 credit bureaus, which is important. So it's going to cost you $99 to get the card, and you do have to make a one-time $100 purchase. So bottom line is, for $199, you wind up getting this card, which with a $5,000 limit, and because you're hopefully not going to run out and spend $5,000 on jewelry,
Hopefully not.
you have a very low balance, and again, after just a few months, you start getting the benefit of that new positive credit card in terms of raising your score.
Okay, so we don't want you guys to apply for this card right around November, December, right?
Well, actually,
no Christmas
not
gifts.
if you're giving jewelry as Christmas gifts. That's absolutely right.
I'm just kidding.
No, but that's actually that. From my perspective, that's a good thing about this card. Is it's not like a traditional MasterCard or Visa where somebody gets it and, oh wow, this is great, and they run down to Rooms to Go and buy a house full of furniture, and now all of a sudden they've got a really high balance on that credit card, which could do more harm than good.
Absolutely, absolutely. So those are the 2 best ways to establish your credit score.
Yes.
So authorized user, but of course everyone, I'm sure, can't find an authorized user.
Well, you were going to do that, right?
Huh?
You were going to do that.
Oh, no. I mean, I won't say I've never done it for family before. I am very big on believing that people deserve a second chance and things like that. So yeah, I have done it before, and like I said, I added as an authorized user and really didn't give any card or anything, so they couldn't use it. They just really got the benefit of the credit that I've had, and honestly, I tell them all the time, I have the same credit cards I've had since 1997. So as a college student, the minute you get on campus, you get free shirts, free cups, all this stuff for free just to apply for a credit card. Well, I actually kept those credit cards, so history-wise, I knew if I added on, I would really help someone as well. Okay, so you talked a little while ago about, obviously if they've had, if they truly had lates and things of that sort, it's just time away from delinquency. There's nothing really that a credit repair or credit consulting company can do for those. So tell the public, when is a good time to call credit consulting? What do you really do? Because obviously, I tell them, hey, if you have lates in the last 12 months, and they're truly yours, no credit company is just going to miraculously remove that information.
That's exactly right.
No matter what you hear, that's not true, correct?
Well, as a general statement, yes, that is correct. Now, in answer to your question, when's a good time?
Yeah.
It's always a good time.
Okay.
And we are always, as a company, we're always in position to look at a credit report. Now, we may just confirm that, yep, you had those late payments, they are what they are. And our piece of advice is, hey, you need to get back on track, make sure you're paying your bills on time, make sure you're keeping your credit card debt low. Those are all of the steps that you need to be taking, but you don't need us.
Right. Okay.
Not right now, anyway.
Right. So, success stories. Tell us. I mean, I'm sure you have plenty. But
Oh wow, yeah.
tell us a credit report. Maybe possible score. And once again, I always say, depending on what it is, would you say that someone doing credit repair should always at least give themselves at least 6 months of repair? I mean, everyone's different, and you may, but I typically say like a year. Give yourself a year. You may not need a year.
Yeah, for as you said, every situation is different.
Right.
And typically when I get questions about credit or credit scoring and reporting, my answer is always the same. It depends. So in our firm's history, if we take somebody on as a client, and we were talking about this earlier, you need them at a particular score. We look at it and say, oh yeah, we found enough mistakes and unverifiable information that we're confident we can get them there. On average, our turnaround time to get them to that mortgage score is 3 to 4 months. Now, some sooner, some longer, just depending on the situation.
And would you say the information that you mainly touch that has this wrongful reporting, are those mostly collections? Because it's not late payments you touch.
It could be late payments can get reported inaccurately.
Okay.
But there's a lot of detail, and without getting into all of the gory detail.
But we want to know.
So, as an example, I mentioned earlier that negative or derogatory information is supposed to stay on the credit report legally for 7 years.
Okay.
So the question is, 7 years from when?
Okay.
Right?
It's a great one.
So the answer to that question is 7 years from the first 30-day late.
Okay.
With the original creditor.
Okay.
That ultimately leads to the most negative status of the account without becoming current again. So let's say I had a Chase credit card and I lost my job, couldn't make the payments, so I went 30 days late, 60 days, 90, 120, 150, 180 days late, and now Chase charges it off. Well, a few months or years later, a collection company buys that from Chase. Okay? Well, when they report it, what they're supposed to put in, and no consumer ever sees it, but on the form they submit, there's a block in there called original date of delinquency. That's that first 30-day late.
Okay.
So let's say that first 30-day late in my example was March of 2016. So if NCO Financial, a big collection company, buys it today, when they report it in that block, they are supposed to put March of 2016. Well, what happens in some cases is they put in the date they bought it.
That's correct.
February of 2020.
Right.
Well, now to the scoring algorithm in the computer program, it looks like it's a brand new collection. And it takes the score
down
and does that. And it's the same way if somebody pays a collection. Rather than they put that paid date in that block, and that's going to artificially lower the score.
Right. So that's important because I tell my borrowers that you shouldn't touch everything on your credit report just because it's there. Because there are some things that they can pay. Let's just say they had a collection from 2015 and they pay it this year. The collection agency could report it as paid, let's just say February 2020, which instead of making their score go up, will make their score go down because it looks like a paid collection in the last 12 months. Would you agree with that?
Well, what can happen is, again, it goes back to that original date of delinquency.
Right, but if they reported it wrong.
Yes, that is correct.
Then it could make their score go down.
Right.
And they probably mostly report it wrong.
Well, a lot of them do.
Yeah.
But here's the other thing that people need to know, and that kind of leads into a question I get a lot. Should I pay a collection? Well, there's a lot that goes into answering that, and there's a lot of factors. Number one, how old is it? As we talked about, the older something is on the credit report, the less it impacts your score.
Okay.
So if you've got one, from 2015, the impact on the score by now has probably gone down significantly.
Right.
Okay. Another thing to look at is, okay, if I'm considering paying this collection, what else is on the credit report? If I've got 5 other collections and I just pay one,
Right.
is that really going to help my score a lot?
No, the more the better.
Probably not.
Right.
The other thing that most people don't realize is they think, well, if I pay a collection, that's a sign of responsibility.
Mm-hmm.
And if I pay it, it's going to make my score go up.
Mm-hmm.
Unfortunately, that is not the case. A paid collection typically will hurt your credit score just about as much as an unpaid one does.
Mm-hmm.
So,
Did y'all hear that? Say that one more time.
a paid collection typically will hurt your credit score just about as much as if you hadn't paid it. So that's the third thing. The fourth thing is there's something called statute of limitations.
Okay.
And I think most of us have heard about that in the crime sector of the world, right?
Right,
Once a certain period of time goes by, you can't prosecute because the statute of limitations has run out. Well, it's kind of that way with credit in the sense that it's different for every state. In Texas, it happens to be 4 years. So if you have a collection that is 4 years old or older
Okay.
from the date of last activity on the account,
Mm-hmm.
there is no creditor that could get you into court and get a judgment against you for that amount.
Okay, so 4 years from the original date? No,
Nope,
then the
4
last
years
date.
from the date of last activity
Okay.
on the account.
Okay.
So, but here's the word of warning with that. These collection companies hold on to these debts for a long time.
Mm-hmm.
So they'll call and say, well, we've got this thing, it's 5 years old, $5,000, but you know what? We know you're a good, responsible person, so all we're asking is a good faith payment of $10. Well, if you make that $10 payment,
It starts your
it
last
starts
credit
that
activity.
4-year clock ticking all over again.
Man.
They could haul you into court
And
the
put a
next
judgment.
day and get a judgment for the entire $5,000. So my point is, I'm not here to tell people not to pay their bills,
Right.
but what I do like to do is make sure they understand what the rules of the game are
Right.
and what their rights are.
Okay. Wow. I didn't know that. I didn't know that. That's great information.
Most people don't know.
Well, I didn't know
Unfortunately.
You know, I didn't, well, I didn't know the statute of limitations, but I also didn't know that if they made that payment, it starts their statute of
Right.
limitations over. So basically, how I feel about it is credit is the most misunderstood, not really, a lot of people don't even understand credit. So that's why you say they can start at any time with you, because you help to teach them all of these things, either establishing a score,
Yes.
reestablishing credit,
Right.
helping with maybe negative items that were reported wrong, and helping them that way. You know, a lot of the times people call me and ask me, you know, who can you refer me to? And I always cringe and I get nervous because there's just so much bad advice out there in the world, and I'm sure you've heard it. I've heard it as a client.
We
That they use a company and they're like, I don't know what's going on. I used them and now my score went down.
Right.
And then when I look at it, they touch certain things. And so, why should someone use y'all? Why
I
should
have no
someone?
idea. Well, I think one big reason, and to your point, and I think in any business, if you're getting your roof repaired or you're going to get your car repaired, everybody wants to find somebody that charges a fair price, doesn't have to be the cheapest, but charges a fair price and gives them good value for what they paid.
Mm-hmm.
So with our firm, and again, because most of our referrals are from loan officers like yourself, so you will refer a client and say, I gotta have this score. Then we will look at where they are on their mortgage score and want to make that point that mortgage scores are not the same as Credit Karma.
Oh gosh, can you please say that one more time?
Mortgage credit scores are not the same as Credit Karma scores, or the score you got from Bank of America, or the score you got directly from the credit bureau. They are all different.
Mm-hmm.
But the only scores that are going to matter when you're applying for a home loan
My
are
scores.
3 different scoring models that JLoan knows all about and can explain to you, and explain to you why the credit scores are different.
Mm-hmm.
So anyway, back to why us. We think that if you're going to take somebody on as a client and take on that responsibility, you have to put your money where your mouth is.
Correct.
And that's what we do. So if for whatever the reason we take a client on and don't get them where you need them, it's 100% money back guarantee for them.
Oh, wow.
So we want to make sure that they're going to get what they pay for. And we put that in writing and we back it up with that money back guarantee.
Right. So I don't ever like to, I don't like to discuss rates on here, and I also don't like to discuss what you charge. And so I won't ask you that question. But is what you charge a monthly fee, a lump sum fee, and is it something that your normal, Joe Smo can afford? Like, do you have to be rich to afford credit consulting? What would you say?
Well, it depends on your definition of rich. I mean, if you're making $15,000 a year, somebody making $25,000 is rich. Okay,
that's true.
But in answer to your question, it's typically a combination of some upfront money and then monthly, depending on how long it takes to fix. So the analogy I usually use is if you've got a funny noise in your car, you take it into your mechanic, and then it depends on, is it a minor tune-up or is it a major overhaul? And obviously the pricing is different.
Okay.
So what we do is we review the situation. Once we understand what needs to be done, we can tell the client down to the penny what their investment with us is.
Okay.
And we think we can show them that return on investment. So we talked earlier about insurance rates and car loan rates over and above mortgage rates.
Right.
Just as a quick example, we had a client who about 6 months before she came to us went out and bought a vehicle and financed just over $30,000 for 7 years at 20% interest because her credit scores were bad. So we did the math and figured out that over that 7-year period, looking at the difference in the vehicle loan rate and the impact on her auto insurance, she was going to wind up paying $39,000 more than she would have if she had a great credit score.
Wow.
So in terms of the return on investment,
is there 100%?
if you would invest, would you invest this to get this amount of money back over a specific period of time?
Right, absolutely.
And that's a great question.
Yeah, that's something that we talk about even when it comes to refinancing. A lot of the time the borrower doesn't, and not that they don't want to pay it, they see the closing costs.
Right.
And they can't see the savings. They're just stuck on the closing costs.
Right.
So we end up doing like an amortization to show, hey, if you stay here,
right,
look how much more you're going to pay. But if you refinance, even though your loan amount's higher, look at all of this you're going to save. So sometimes people are just very visual,
right,
and you have to, kind of show them that.
Gee, it sounds like the credit business.
Yeah.
Every situation is different.
Every
right?
situation is definitely different. So, is there anything else you want to say? Cheryl, you have any questions?
Well, just a few things
Okay.
maybe, and I touched on it earlier with regards to, that ounce of prevention being worth a pound of cure. So if you look at what goes into getting and keeping a great credit score, it's really not too difficult. I mean, number one, pay your bills on time.
Yeah.
Duh.
Yeah.
So make sure all your payments are made on time.
Okay.
The second biggest thing is we talked about credit card balances, right? So there's some things out there that say, well, keep your credit card balances under 50% or under 30%. Well, the reality is that you start losing points on your credit score when your balances exceed 10%.
10%, yeah.
Now, the higher they go, the more points you lose.
Right.
Okay, but here's a key to that. Question becomes, well, when do they look at your balance?
That's a great question. Listen.
They look at your balance, or here's what happens. So on every credit card, you have a billing period. Let's say it's from the 15th to the 15th of each month. So you've got a $5,000 credit card. You charge up $4,900 during that billing period. Billing period stops, and they send you the bill, right? Well, guess what? They're sending that $4,900 number to the credit bureaus. So when the credit bureaus look at that, wow, you're over 95%, even though you might have paid that in full 2 days later, they don't know about that.
Right, okay.
So the key to, if you will, beating the system is to go online a couple of days before your billing period ends
Okay.
and pay it off, or pay it down as low as you possibly can. That means that a couple days later, when they report, they're reporting a very low balance instead of a higher balance, if that makes sense.
So what, I have a question with that. What about we're not talking about your 800 score borrower. What about your borrower who's looking to establish credit and they get a card and every month they use it, but they pay it off right away? How does that, I've been always told, but it's always nice to know, that it doesn't help them build score because the zero balance has no memory. So can you explain, is that true? Is that not true?
Well, it depends.
Okay.
It depends on, and again, going back to what got reported when. So let's say, again, you get a new credit card, it's got a $500 limit, and so you go out and charge $300 on it. Now, if you paid it off 2 days before and then didn't charge anything, what's going to get reported on your statement date? Zero, because you had a zero balance.
Right.
Does that make sense? Okay. But if you wait and let them report that $300 and then pay it off in full, you're going to get the impact. You won't report zero because it got reported as $300.
Right.
So usually what I recommend when somebody's getting a new credit card and the primary goal is to build credit, get a credit card. Really doesn't matter what the limit is.
Right. Whether it's 100, 300,
300, 500. Get the card, go to Kroger, buy $10 worth of groceries,
let it report.
come home, take the card, put it in the sock drawer, don't touch it again. That way, when the bill comes in, what got reported?
$10.
$10 against $100 or $200, $300.
Right.
You're in perfect shape. Then you can pay it off in full.
Right.
And wash, rinse, and repeat. Do the same thing the next month, and the month after that, and the month after that.
Right.
And every month that you do that, you're building credit history, which the length of time you've had credit is 15% of your credit score.
Okay. So let's talk about that real quick, because we didn't talk about that. What makes up your credit score? So we got length of history.
Length of history is 15%. 35% is how well you pay your bills.
Okay.
You pay your
so
bills
that's the huge one. How well you pay your bills.
But
okay.
Right behind that, at 30%, is what they call how much you owe. But when they say how much you owe today,
is it in total?
Well, it's in total, but the real high emphasis is on your revolving or credit card debt.
Okay.
So you could have a whole bunch of cars, you could have multiple homes, and they figure as long as you're making those payments on time, it's no big deal, because one thing that they never look at when calculating your credit score is how much money do you have or how much money do you make.
Okay.
Okay? But what they do want to look at is, well, here's how much the lenders said they would give you, and how much of that are you using, which is that balance to limit ratio.
Okay. So that's where, so a lot of the times people think it's total debt, but it's not. It's really revolving.
Well, it's total, but the very, very high emphasis is on the revolving.
Okay,
Absolutely.
So we got length of history, we got how well you pay your bills.
Right.
And
how much debt you
how
have,
much debt you have.
revolving.
So that's 30%.
So now we've got 30 plus 35 is 65 plus 15 is 80. 10% is what's your mix of credit. And again, I think I mentioned before, what they'd like to see is at least one installment account, like a car loan.
So an auto or a mortgage, right?
And 2 revolving accounts, so 2 credit cards.
So ideally. Those credit cards though, do they like major or store, like Target and Kohl's? Does it matter?
It does.
It doesn't?
It does.
Oh, it does, okay.
They like to see majors.
Majors. So stay away from the 0%.
Well, you don't have to do that. And in fact, that's one thing that can be a good thing. If Rooms to Go says, well, come and buy a house full of furniture, $5,000, and we'll give you 0% interest for 5 years as long as you make the payments on time. I'm fine with that.
Right, but we don't want you to buy the furniture before the house, so don't go to rooms to
that's
go.
Right. That's right.
Don't furnish the apartment, please. Wait.
But here's the key when you get into those type of things. You absolutely have to make sure you're making that payment on time every month, because if you're 1 day late, one time,
listen,
they can go back and charge you these outrageous interest rates from day one.
From day one. So if you listen to this clearly, because a lot of people don't read the fine print or know. So if you get that 0% 5-year furniture deal, and 1 month, let's just say 24 months in, you are late on that 1 month, that creditor can go back 24 months and charge you all of that interest. So you better make those payments on time. Okay, so now we have, let's go over again, length of history, because I know this, but I want to make sure that I'm memorizing this.
Right.
So length of history, payment history,
right,
overall debt amount,
right,
mix of credit,
right,
and then the last one, oh my gosh, we get it all the time.
The last 10% is how much new credit that you have, and when they refer to new credits, they're looking at inquiries. Okay.
Oh, okay.
So, and there's some misinformation out there about inquiries.
There is. Yeah.
So there's two types of inquiries: hard and soft.
Okay.
Soft inquiries will never impact your credit score.
What is a soft one? What's an example?
Well, there's 3 types of soft inquiries. The first type is promotional. That's when you get those pre-approved credit card offers in the mail. Right?
Okay, all right.
So what happened there was the credit card company went to the credit bureau and said, oh, I want a list of everybody in this zip code that has a credit score of 720 or better, so I can send them a credit card offer. Well, obviously they had to look at your credit file to see where your credit score was, but that in and of itself did not impact your credit score.
Okay.
Secondly, when you check your own credit report and scores, you can do that 5 times a day, every day, 365 days a year. It will never impact your credit score.
Okay.
That's number 2. And number 3 is what they call account review. And that is where you've already got a credit line established with a lender.
Okay.
And they're looking at it to see if they want to make any adjustments to that limit.
Okay.
American Express looks at every customer's credit every single month. So
Right.
those 3 will never impact your score. When you actually apply for credit, that is what's called a hard inquiry. And it can impact your score. It doesn't have to, but it can.
So an auto loan, a mortgage, a major credit card, right?
Well, there's kind of 2 segments, okay? And so let's take mortgage, auto lending, and student loan lending.
Okay.
In those 3 arenas, they expect you to shop for rates. So you can have as many inquiries as you want for that same purpose.
Okay.
So if you're shopping around for a car, you could go to 20 different lenders as long as it's within a 30-day period.
There we go. Okay.
And it will only count as one inquiry in terms of whatever impact it's going to have.
So I'm just going to interrupt you here. For all my borrowers who call and say, I don't want you to pull my credit because it's going to impact my score. If I pull your credit, I'm one hard pull.
That's
and
correct.
then they have 30 days to shop around.
Right.
Now, is there a certain number of inquiries that you're allowed in a year before it starts impacting your credit score?
No.
No, okay.
There is not. Now, for those 3, you can have multiples within that 30-day period.
Okay.
You mentioned credit card. Now, if I go and apply for one credit card, how much is it going to impact my score? It depends.
Oh, I was going to say, I don't know.
Depends on what else is on my credit report. I've seen anywhere from 0 for as much as 40 points for one inquiry. So
On a credit card?
any type of inquiry.
Okay.
Any type of inquiry. So now if you go out and if you think about it for a minute, I think it makes sense. If you go apply for one credit card, that's fine. If you apply for 5 credit cards within 1 month, that's a red flag. Why is this person applying
For so much
for
credit.
so much credit?
Okay.
And that could impact their score more.
Right. But
Okay.
why would, I know you're probably not going to be able to answer this question, but I'm going to ask you anyway.
Okay.
So you said you've seen it so much as one inquiry could lower a score 40 points, but why? Like, why would that happen?
Well, an inquiry is only when it hits the credit bureaus. An inquiry only says that you applied for credit, and it doesn't tell them what type of application it was. Could have been for a cell phone, could have been for a credit card, could have been for a car. And all it says is you applied. It doesn't say whether you've been approved or not. So when they look at your credit file and what is in there, if you're all maxed out on your debt, they tend to get more nervous than if, well, you got all this available credit, but you're really not using very much, and in that case, the impact is probably lower.
Okay, well,
So,
that makes a lot of sense.
Again, it's just good to know that you probably don't want to be going out and applying for a lot of different types of credit within a short period of time.
Okay.
Inquiries do stay on your credit report for 2 years, but they impact you most heavily in the first 90 to 180 days, and then the impact starts to fall off pretty goodly.
So if somebody was getting ready to apply for a mortgage, or somebody's looking to purchase a home in the next 6 months, would it be your advice to kind of just like not start applying for credit? There's just really no need. You just need to kind of just live a very frugal,
and I know you've
quiet
never
life.
seen somebody apply for a mortgage and just before closing they go buy a car.
Well, actually, knock on wood, I've personally, here's the wood, somewhere you hang. Okay. I've never personally had it happen to me, but I have had co-workers that I have worked with that have had that happen. So now we send out a do not, things to not do.
Do's and don'ts.
Yeah, do's and don'ts. We send that out to let our borrowers know, like, hey, as soon as we get in contact with you, these are the things that you do not want to do, because you don't want to impact. The thing about it is, at any point in time, there are times where that an underwriter could require that we have to have something removed from your credit or something of that sort, which would require us to re-pull your credit.
Right.
So if you've done anything and we re-pull and your score goes down, it could leave you in a position where you no longer qualify for a home loan. So you got to be very careful on what you do. And plus, lenders, we monitor from the moment we pull your credit and your credit goes into actually processing. We turn on an alert, and that alert watches you all the way through funding. So any inquiry that you make, we get alerted, and we're going to come back to you and ask you, why did you have an inquiry? What was that for? And make sure that you didn't open any new debt that we don't know about. So we also ask for the inquiries that are already on your credit report, because we want to make sure, did it not get reported yet? So if you had this inquiry for this auto, did you buy a car? Because it's not reporting right now. And 9 times out of 10, if they've inquired for a car, they bought a car. And depending on when you pull, we may not even have that auto on there. So it's just very important that we ask those questions. You have been so awesome.
Well, just a couple of other real quick things, because we talked about how to get and keep a great credit score, right? So it's always good in anything we do where we're in control.
That's correct.
Right? So a couple of examples of what can happen if you're not careful. So let's say that you have a son or daughter and they graduate from high school and they want their first vehicle. Well, they don't have any credit, so they're not going to get a very good credit score or credit rate for that loan. So what happens? Mom or dad says, no problem, I'll co-sign for you. So you co-sign, which means now you're responsible along with them, but you tell the child, well, this is your car, so you make the payments. Well, that's great until 6 months later, junior is 30 days late on the car payment. Well, guess whose credit report that shows up on?
The mom's.
That's exactly right.
Don't point at me, I don't want that.
Well, I mean, some people say never, 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 ever
Right.
cosign. Well, you can cosign, but if you're going to cosign, my advice is you make the payment. So you know that it's being made, and you know that it's being made on time, and then you can go collect the money from the person that you
That's
cosign
correct.
for.
I 100% agree with that method.
So
Repeat that again, just so you know, you can cosign, but obviously make sure you cosign for somebody that you at least feel is responsible, but don't let them be the one to make the payment, because we hear it all the time.
Right.
Well, my son just stopped paying and I didn't know, or so you pay the payment, you make them pay you either. There's so many ways. They can Venmo, PayPal, Zelle.
Exactly.
I think that's what it is. Zelle?
Yep.
They can Zelle it. There's so many ways to do that.
Right. So that's number one. The second area that we see a lot is as a result of divorce. And the classic case is husband and wife come into divorce court, and they have a home, they have a couple of cars, and all of those are joint accounts. Okay? Mm-hmm. So the husband says, well, I'm going to keep the house and I'm going to keep car A. And the wife says, well, that's fine with me, I'm going to keep car B. And so the divorce court judge says everybody's in agreement, right? Mm-hmm. Yes, we are. Gavel comes down, so ordered. Well, if they don't refinance those accounts, same example. 6 months down the road, the husband's late on the mortgage payment. Mm-hmm. Guess whose credit report it shows up on? The ex-wife's. She screams bloody murder. No, the divorce court judge said that was his responsibility. Unfortunately, a divorce decree does not overrule an existing financial relationship. So what should be happening is when couples divorce and they have accounts that are in both their names, those accounts should be closed, all of them, one way or the other, or refinanced in one person's name, so that nobody, because I've seen situations where vindictive exes do things just to hurt their ex from a financial standpoint. Right.
So that's a great point. We deal with that here. So a divorce decree doesn't change. Here's what I say. The divorce decree doesn't change the fact that you were both financially responsible for the debt that you created before you divorced. So even if the divorce says, hey, Bobby got the house and I didn't, and Bobby defaults, we as a lender can't change the fact that it impacted your credit score.
Right.
What we can do as a lender with the divorce decree is exclude the debt from you qualifying for a new mortgage. But if it financially impacted your score due to late payments, foreclosure, or short sale, there's nothing that we can do as a lender to change your score.
Right.
That's exactly what he's saying. So, number 3.
Well, number 3 is have a safety net account. Mm-hmm. A lot of times what will happen is, and I think a good example was the last government shutdown.
Yeah.
I mean, there were people on TV that were saying, oh my God, if I miss a paycheck, I can't make my car payment. Well, that's because they don't have any money in reserve. Most financial advisors will recommend
3 to 6 months.
that you have at least 6 months worth of income set aside, so that, let's say something like that does happen. You get sick and can't work, or you have an extended job loss. If you have that money in reserve, you can still make your payments on time.
That's correct.
And not have to recover from those late payments or charge-offs or collections on down the road.
And we look at that here as a lender, just not on a credit standpoint as well. There are some files, everyone's story is different. So yes, sometimes if you have a better overall picture, great credit scores, money in the bank, all of that stuff, your file may fly through. But there are some files that ride the fence. You don't have really strong scores, or maybe you have some stronger scores, but your work history is kind of sketchy, and it comes to an underwriter's decision on your first home, over 50% payment shock, and the underwriter's looking that you're going to spend all of your savings and assets when you close this home.
Right.
There's a likelihood on our side that the underwriter's going to say, I really don't feel safe or like this, because you have no money in reserve. So even on the lender side, and I preach this all the time, try to save at least 3 months reserve when you're going to apply for a mortgage. And that can be in a 401k, at least one that you can touch.
Right.
But obviously the safer way is 3 to 6 months, or at least 6 in an actual like savings account that you don't have to draw or take penalties from or borrow or loan on a 401k. Obviously everyone's story is different, and to some it may be easier to save, and some it's a little harder. But I will say every little bit helps, whether it's $20 a week or $50 a week, whatever's in your budget. Just try to save some money, especially just for your own well-being, government shutdown.
Right.
But also if you're looking to buy a home, it's very important that you're not spending all of your money just on closing on your home.
Absolutely. So one other quick thing, student loans. Student loans have gotten to be a real issue in this country, as I think we all know.
Absolutely.
Recent numbers came out that the total amount of student loan debt in this country is over $1.6 trillion. And what typically happens is somebody goes out, takes out student loans because they want to go to school and get a good education so they can get a good job, right?
Right.
Makes sense. Well, then they run up all this student loan debt and they don't get that real high-paying job right away. Next thing you know, they've got a problem, they're behind, and in a worst-case scenario, those loans go into default and into collection. So now what? Well, one option is if the student loan is federally backed, which the vast majority of them are, go to the U.S. Department of Education and ask them what your options are. They may be able to help, as an example, with what's called a rehabilitation loan. And without getting into all the gory details about it, they look at how much student loan debt that you have defaulted on, create a brand new loan, and they use a formula to determine what the monthly payment is going to be, and that formula is all based on your income. So in a lot of cases, what can happen is they can lower that monthly payment to where now it's affordable for you, and you can start making a dent in that student loan, other than waiting for Elizabeth Warren to get to be president, and then she'll wipe out all the student loan debt in the country. So that's one option. So I only bring it up in the sense that just because somebody might have student loans that are in collection doesn't mean that all is lost.
Right. There's still hope.
There is hope. Go to the U.S. Department of Education, and if you can get into that rehabilitation loan, the good news is, once you're in the loan, you go back to them and say, hey, I'm trying to get a mortgage loan approved, but wow, these loans that I had in collection are really hurting my credit score. Can you help me with that? In a lot of cases, they can. So it never hurts to ask. And if they can, then that's great. You got number one, now you have a loan that you can afford to pay. And secondly, they'll help you get rid of some of that nasty stuff on your credit report.
Well, that is great information. I'm going to look and see. Most of the time my viewers are quiet on here, but let's see if you all have any questions on here. There's people watching, but a lot of the times they don't have any questions, in which we can close out, but let's see. All right, so if you guys have any questions, obviously my guy Rob Stuart, his information is right behind me. So you have Ace Credit Consulting. His number is there, 972-742-2914. Or if you just want to email him, ron@acecreditconsulting.com. So that has been such great information that he's provided on here. Please reach out to him. Obviously I want to help you with home loans, but my big goal is financial security and helping your family outside of homes with just being able to save money, have great credit, and to kind of just live your life. So if Ron can help you with anything, please reach out directly to him. For all of your financing needs for your home, always remember to call your girl JLoan. I'm happy to help you. Happy Friday. Have a blessed weekend, and we'll talk to you soon, okay? Bye-bye.